Hello and welcome to Portfolio Matters, weekly markets checklist, week 158. But before I get into it, I will read the disclaimer. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we'll be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Full disclaimer can be found at the end. Okay, before we get going, a couple of housekeeping items. First of all, reminder, next pub night is on the 24th of June. I am recording this on Thursday night. Richard will be joining for some key sections. So all the data is as at the close on Thursday night, London close. So news this week. Well, Rishi Sunak has called a UK election for July the 4th. All the polling data I have seen indicates that it's going to be a total massacre, with Labour getting a huge majority. Now, the big economic news of the week was that April UK inflation numbers came out and they were good, but not great. So UK inflation fell to 2.3%, which you'd expect was great news, but it missed expectations of a fall to 2.1%. And the market concentrated on services inflation, which remained high and persistent at 5.9% in April, down only slightly from 6% in March. Services inflation is persistent. As a result, markets have pushed back their expectations for UK rate cuts to September now. This may be old news now, but the UK Chancellor Jeremy Hunt indicated he intends to cut taxes again before the next election. And the IMF warned that the UK faces a 30 billion funding gap and told him not to. We will see whether he still intends to do that. Elsewhere, Nvidia beat forecasts with revenues up an absolutely astonishing 265% year on year in Q1 to 26 billion, which beat estimates of 24.7 billion. In Q2, revenues are expected to slow to 28 billion. So, amazing numbers, but growth is expected to slow from here. Both copper and gold prices hit new highs this week before retreating. Whether that is just noise or near-term peak is open to debate. We'll show you the data in a bit. So this is the expectation for UK rate cuts in June. So before the UK inflation data came out, the markets were putting an expectation that the Bank of England would cut rates in June at more than 50%. Right after, they've reduced that probability to only 15%. In Japan, the bond yield has breached the 1% level and is rising further. So Japanese bond yields are rising towards rates elsewhere in the world. But bear in mind, they have debt to GDP ratio of 250%. If this continues and they have to refinance all their existing debt at these higher interest rates, then their debt becomes unsustainable. Watch this space. So Nvidia shares are up now 10% post results. Results were last night. So the AI revolution has really taken hold this year, with its revenues up 262% year on year. Astonishing numbers. In the US, Donald Trump is well ahead in the polls, and that has big implications for the US fiscal deficit, the taxes, etc., etc. Trump is likely to be more protectionist, but also he's unlikely to want to rebalance the fiscal deficit. And finally, onto the UK. So these are the latest predictions for the number of seats each party will get in the forthcoming election on the 4th of July. And it is not good, actually, because Labour are forecast to get an absolutely enormous majority of 308. And frankly, whenever one party, and I don't care which party it is, has an enormous majority, good policy does not follow. They can basically push through whatever they feel like. The country is best governed when there is a small majority, and like it or not, one party has to negotiate with the other parties to get policy done, and a consensus needs to form. Okay, on to this week's economic data. So, quick summary, the UK data is mystifying. Is it strengthening or weakening? So last week we had the unemployment numbers, and that showed a rise in unemployment and a fall in employment, but at the same time GDP is growing. What's going on? This week we've had poor inflation numbers and rather indifferent PMIs. We'll show you the data in a bit. EU weak, but appears to have stabilized and bottomed, but not really growing very fast. The US is strong. There are some signs its rate of growth is slowing, but the most recent data suggests that it's stable. China, difficult to tell. The global manufacturing sector shows signs of a cyclical upturn. On to the UK. So the big numbers out this week were UK inflation. It was expected at 0.2%. In April, it came in at 0.3%, a small miss. Not great, but still actually a good number. And Kantar reported separately that UK grocery price inflation in May, so this month, fell further to 2.4% year on year, which means that hopefully goods inflation should keep on falling in May. Now, the April number, of course, was flattered by the reduction in the household energy cap. So this is the year-on-year numbers. April inflation falling to 2.3%, slightly missing expectations of 2.1%, but still, frankly, a very good number. It was core that's the problem. So core, excluding food and energy, actually rose 0.9% month on month in April. That is a very bad number. Missed expectations of 0.7%, and that's a big rise on March, and annualized is a terrible rate. And year on year, that meant core fell to 3.9%, missing expectations, but still down and trending lower. RPI met expectations, and it's 3.3%. That is a big drop on March. Okay, so the good news on UK inflation is that we are no longer an outlier. The UK is the dark blue line, and actually CPI inflation is below that of the EU 27 now. The bad news is if you break down UK inflation into goods and services inflation, then you'll see goods inflation is now negative. Services inflation is just not coming down very quickly. It fell to 5.9% in April from 6% in March. Really not coming down at all, far too high. And if you look year on year, then most categories fell year on year, particularly housing and household services, which is energy, but in the year to April 2024, restaurant and hotel prices rose faster than in the year to March. So services inflation is sticky. And the inflation numbers in March benefited from this big reduction in the energy price cap, but that deflation will fade in the coming months. The great news is that food price inflation continues to ease and will ease further in May. UK rental inflation is much higher over the past year than inflation. So because rents are only renegotiated once a year, they lag, and rental inflation is only now catching up with the increase in general inflation, and that will tend to drag UK inflation higher. Input producer price inflation was 0.6% in April month on month, worse than expectations and massively bigger than March, whereas deflation. Year on year, input prices are still falling, but they're rising again. Output price inflation was much more reassuring. It was 0.2% in April, so factory gate inflation was low, and that missed expectations, was unchanged from March, and year on year is at 1.1%. So factory prices really not changing much at all, although the trend is definitely upwards. We also had the S&P Global PMIs for May, and manufacturing better than expected. It was expected at 49.5, i.e. still in recession. It actually rose to 51.3, continuing a general trend of improving activity in the manufacturing sector, and that was much better than in April. Reminder though, all the evidence suggests that there's very little relationship between the PMIs and actual activity. So this seems to be how manufacturers feel about things rather than what's actually going on in the manufacturing sector. Services sector faded down to 52.9 in May, well below expectations and down on April. So that meant the composite fell to 52.8, which shows a UK economy which is growing but weakly. The CBI industrial trends new orders again seem to contradict the PMIs. In May, it's minus 33. So industrial new orders fading again. And the public sector borrowing requirement came in the fourth worst on record at minus 20.5 billion, missing expectations and growing again from March. So the UK government, despite cutting taxes, has not got its fiscal house in order. And that leaves the UK's debt to GDP ratio at 97.9, the highest it's been since the 60s and the aftermath of World War II. The good news is the Citigroup Economic Surprise Index is very strongly positive. So the UK economy is outperforming expectations. The bad news is that rising GDP is not translating into higher employment. The Indeed Job Postings Index continues to fade. And when we talk about persistent services inflation in the UK, well, wage growth in April ticked up to 6.4%, according to Indeed, which is not terribly surprising given the 9.8% increase in the minimum wage. Also not reassuring was Trueflation, which ticked back up to 3.2% last week. Reminder, Trueflation is not seasonally adjusted, and most UK inflation happens between February and May. Hopefully, when we get May this month out of the way, inflation should start to fall. And this is the National Institute of Economic and Social Research's GDP growth forecast. And they're forecasting that Q2 will also be a strong quarter for UK GDP growth. Reminder that the IMF is forecasting that total UK GDP growth for the entire year will be 0.5%. And given that we had GDP growth in Q1 of 0.6%, and the NIESR is forecasting growth of 0.6% in Q2, well, the IMF look overly pessimistic. So, bottom line is the data on the UK economy is perplexing. It is growing, actually growing quite decently. If you think about Q1 growth of 0.6% and forecast Q2 growth of 0.6%, then we're looking at an annualized growth rate of 2.4%, which frankly, by historic standards, is pretty decent. But at the same time, unemployment is rising, employment is falling, and posted job openings are also falling. So perplexing. If that continues, then surely the GDP growth should also fall. Onto the EU. So we had the PMIs, and European manufacturing also seems to have turned a corner. The May number was 47.4, up from April and beating expectations. So European manufacturing doing better, but still in recession. The services PMI was unchanged on April, which missed expectations. The composite therefore increased marginally to 52.3. So I think you'd say there was a general upwards drift in European economic activity, according to the PMI. The usual provisos apply. EU consumer confidence, the flash number for May remained pretty poor, but actually up on April, though slightly worse than expectations. The bad news for the ECB is that negotiated wage growth in Q1 came in well above expectations. It was expected to fall to 4.3% compared to Q4. It actually rose to 4.7%. Not good. And the flash labour costs index for Q1 was at 4.9%, massively higher than expectations and up on Q4. So the big question is, how is that going to affect the ECB? Previously, they had been expected to cut rates starting next month, but persistent wage inflation could force them to delay that. Now, the commentary I have read is that they are likely to cut in June anyway, because of this chart, which shows the survey of employers and their wage intentions, and that has dropped dramatically. And it seems that the cause of the high wage print is just a lag. So workers demanding compensation for historic inflation, and going forwards, the expectations are that wage inflation should fall back towards a towards a level consistent with the 2% target in the coming months. EU balance of trade was good, up in March compared to February, and well ahead of expectations. So the EU continues to be a strong net exporter. Construction activity also bounced back year on year in March, up 0.1%, much better than expectations, although the February number was revised down. The Citigroup Economic Surprise Index is fading again. So whether that means that the Eurozone economy is doing worse or economists' expectations have risen is an open question. The job openings index in Germany continues to fall, and in France it continues to fall. Now, this is the forecast for Europe's working age population, and it is forecast to shrink quite markedly over the next 10 years. So we previously had this debate over whether an aging population is inflationary or deflationary. Well, we're about to get a live, real test in Europe. Compare that with the US, where the working age population is expected to keep on growing. Bottom line is, EU economy is weak, and wage growth is persistent. There's very little evidence of inflation. So will the ECB cut rates next month? I think they will, actually. On to the US. So PMIs first. Manufacturing returned to growth in May, up on expectations and up on April. The big surprise was services, and that is a big number. That's a big bounce, 54.8, much better than April and well above expectations. As a result, the composite surged to 54.4. So the PMIs show a US economy that seems to have got over its recent bout of weakness. The one proviso I would add is that the employment subindex continued to be weak at 45. So although employers were more confident about the outlook for their companies, they were not intending to add jobs. The Chicago Fed National Activity Index for April was minus 0.23 standard deviations. That was worse than March, and the March number was revised down from its previous 0.15. So according to the Chicago Fed National Activity Index, the US economy is currently working below trend. But you'll notice that last year, when the US economy was going great guns in Q4, it was saying that it was also operating below trend. The diffusion index is at minus 0.08 in April, and a recession is associated with a figure of minus 0.35, so nowhere near that. Existing home sales faded to 4.14 million last month. Existing home sales have collapsed to their post-GFC levels. New home sales also fell to 630,000, below expectations and below March, and the March number was revised down. But that's still an okay number. Building permits met expectations, down on March at 1.44 million. Again, that's a strong number. That is stronger than 2016, 17, 18, 19. And the strength of the US housing market is an enduring mystery. Home builder confidence is plus 45. Home buyer confidence is 26. And that is the lowest it's been in 50 years. But still, as you've seen, new home starts continue to be quite strong. The Conference Board leading index for April was minus 0.6, which is worse than expectations and down on March, but it has bottomed and it is no longer forecasting a recession. So it appears to have given a false signal. Johnson Red Book retail sales 5.5% year on year, down on last week. 30-year mortgage rate remains above 7%. The mortgage purchase index, i.e. the number of mortgages taken out to buy homes, continues to fall. Initial jobless claims, seasonally adjusted, was at 215,000, which was lower than expectations and down on last week. Continuing jobless claims continue to rise. The Dallas Fed weekly economic GDP forecast actually rose sharply last week to 2.2%, up from 1.7% the previous week. So Dallas Fed thinks the US economy is doing just fine, thank you very much. The Atlanta Fed have not updated. They still think that Q2 GDP growth is coming in at 3.6%. The New York Fed also unchanged, 1.9%. The Citigroup Economic Surprise Index continues to fall at minus 23.8. So the US economy is surprising to the downside. Let's see what happens when this week's PMIs are included next week. The job postings index continues to gradually fade, down again in the week ending May 17th. Jobs growth is also fading at 3.1%. US trueflation, well, it's up quite strongly on the week at 2.5%. not terribly high, but still it is not trending back towards the 2% target. So the Brave Butlers Kelly indices for April show the US economy continues to grow slowly, and the leading index is still very good. Reminder, the Brave Butlers Kelly indices use around 600 live data series to get a broad-based assessment of how the economy is doing. And it is not showing any signs of an imminent recession. Cumulatively, the US CPI is 11% above the 2% trend since pre-pandemic, which is actually less than I expected. And this is the America's goods deficit with China, which has actually really fallen quite sharply after tariffs were imposed by the Trump administration. But if you're going to take away a single chart from this week's US chart pack, it should be this. Now, the quarterly census of employment and wages for jobs growth in 2023 shows that jobs growth was 1.5%, not the 2% that the BLS, the Bureau of Labor Statistics, estimated in its non-farm payrolls. And that equates to 770,000 fewer jobs. So that is further evidence that the non-farm payrolls report is overestimating the strength of the US labor market. US summary, well, very little data this week. The main data was the PMIs, and the PMIs surged to new cycle highs, which is very unexpected given the fall in, for example, the Citigroup Economic Surprise Index. And we know retail sales, for example, surprised to the downside in April. So, but employers are feeling more confident. Job postings continue to fall. Bottom line, US economy is resilient. Okay, on to China. No new data this week, but this is quite interesting. So Chinese industrial output on the left has grown above trend since the pandemic. So there's a huge surge in goods demand during the pandemic, and Chinese industrial capacity production has continued above trend since then. Retail sales, however, are well below trend. So China is not transitioning its economy away from investment towards consumption. And there's a strong correlation between subway traffic in the major Chinese retail in major cities and retail sales. And it suggests that retail sales ain't going anywhere soon. Now, the FT had a report yesterday, and this shows the stock of unsold properties in China, and that is in million square meters. So that's 600 million square meters of unsold properties. And that is worth $4.1 trillion. Now, last week, the government announced a support package worth $410 billion. So it's good, but nowhere near enough. And meanwhile, Chinese property developers' sales continue to fall. And in the year to, is that April, they fell 50%, best part of. So the property sector in China is not doing well, and I'm not sure where they've got this data from. Thank you to Wayne J for sending us this. But according to True Insights, Chinese house prices fell a further 1% in April alone. Reminder, we've previously shown you the official data, which shows Chinese house prices falling 1% year on year. This data seems much more believable to me, and that shows fall of 1% in April alone. Given the huge surplus in unsold properties in China, this makes much more sense than just a 1% fall, as reported by the Chinese State Statistics Office. China summary, no new data this week. Bottom line, China's economy seems to be doing fine, frankly, but rebalancing, but doing more of the same, loads of industrial investment and not rebalancing towards consumption. The property sector continues to do badly. Okay, on to one chart. Now, the purple line is the S&P 500. The IYT is the transportation index, and the two are separating. Now, normally, historically, the transportation index tends to be a harbinger of problems in the US economy. What it's saying is that the volume of goods and people being moved around the US economy is falling. However, as the US stock market transitions away from real economy stocks to IT sector, technology stocks such as Nvidia, it is questionable whether this historic pattern holds. But the fall in IYT suggests that the US economy is not doing as well as it has been. And on to the SAHM and Kantro rules. Now, we have talked about this before. The SAHM and Kantro rules try and predict whether there's going to be a US recession based on changes in unemployment. And you see the Kantro rule has actually triggered, whereas the SAHM rule is actually getting quite close to triggering. Now, what are they? So the Kantro rule just looks at the raw number of people employed. And it triggers if the number of unemployed people has increased by more than 10% in the course of a calendar year using the 3-month average. That has now triggered. The SAHM rule looks at the unemployment rate, and it triggers if the unemployment rate has increased by 0.5% from its minimum over the previous 12 months. And you can see here that it is getting close to triggering. It is, I think you'd say, slowly trending upwards, whereas the Kantro signal has triggered. And looking back, there's only, I think, one false signal going back to 1970. And when you look at recession since 1970, the lag between the signal and recession is getting shorter. So according to this, the Kantro rule suggests an imminent recession in the US. The SAHM rule has obviously not triggered yet. But this time there are good reasons to expect the SAHM and Kantro rules may give false signals. It's because the US has experienced massive net immigration over the last 3 years. Estimates are of up to 10 million. And as those new immigrants become eligible to work, then if they don't find a job, they can be classified as unemployed. Now, reminder, the BLS classifies somebody as unemployed based on a survey of households and whether people in that household self-declare that they're eligible for work but unable to find it. So that could lead to a rise in the unemployment rate without people actually losing their jobs. So further to last week's discussion about how the pandemic inflation was not caused by demand shock, but was in fact caused by supply shocks, this week we're going to be talking about the money supply. So, first of all, we're going to be defining the money supply as M2, okay, which is the main way the US measures M2, and that is defined as the sum of cash, checking deposits, and other deposits readily convertible to cash, such as CDs, which are certificates of deposit. Okay, so M2 rose very sharply during the pandemic and actually rose by 35%. So there was an enormous increase in the money supply in the US. So why was that? Well, that was mainly due to the Fed. So during the pandemic, the Fed pumped extra liquidities into banks to allow them to maintain normal market functions without having to sell bonds to generate cash. And it intervened in lots of different markets to buy bonds for cash, such as the MMLF, the Money Market Liquidity Facility, the CPFF, Commercial Paper Liquidity Facility, etc., etc. These are all different forms of QE, basically swapping cash, so giving banks cash in return for different financial assets. And so you see, this is the Fed's balance sheet, which absolutely shot up during the pandemic. And the consequence of that was that M2 rose by 35% between January 2020 and now. And that is despite it actually having fallen over the last 2 years. Okay, so a brief history of monetarism. Now, during the 1960s and 70s, there was a strong but lagging relationship between inflation and the money supply. Pause, take a look at this chart. And as a result, economists led by the American economics professor Milton Friedman believed that the key to controlling inflation was to limit the increase in the monetary supply. And that doctrine was termed monetarism and became very fashionable at the end of the 70s when everyone was searching for a solution to the very high inflation of the 1970s. But the problem was, the moment they tried it, it didn't work. Basically, you can see here the relationship between inflation and the money supply just completely broke down. The blue line is the change in CPI. The green line is the change in the money supply. There's no relationship whatsoever. And this reminds me of Goodhart's law, which is when a measure becomes a target, it ceases to be a good measure. So in this case, when you're trying to use changes in the money supply as a target to control inflation, it doesn't work anymore. That meant monetarism became discredited, and the main reason that monetarism failed was actually it proved very difficult to define what is money and what is M2, what is cash, because the financial innovations of the 1980s meant that there were a whole load of short-term money-like instruments that arose, and defining what was money became increasingly difficult. So what's the situation now? Well, monetarism remains discredited to the extent that in its models, the Bank of England had stopped looking at the money supply. And you may be aware that Ben Bernanke has done this review of the Bank of England's inflation forecasting systems. And one of his recommendations was they should put it back in. However, although the short-term link between the money supply and inflation is variable and unreliable, there is a strong medium to long-term relationship between the growth of money aggregates and the price level. So increases in the money supply are associated with long-term increases in the price level, but not year-on-year changes in it as measured by inflation. So that leads us to, was the pandemic inflation caused by an increase in the money supply? So this is M2, change in M2 year on year with CPI, and you can see, and this is Mr. C Peckham's point, that there's no relationship. It's completely unreliable. During the Great Financial Crisis, you'll see that M2 rose sharply and prices collapsed. But during the pandemic, there's a massive increase in M2 and inflation followed. Now, the relationship you saw in the 1970s was that there was a 2-year lag between changes in M2 and inflation. And I actually downloaded the data and imposed a 2-year lag to see if I could improve the fit. Frankly, I couldn't. That still looks like noise. But it remains the case that there was a 35% increase in M2 and a 21% increase in the price level in the US over the period. So is that just a coincidence? I think not. Now, an increase in the money supply need not actually lead to an increase in inflation. The rise in the money supply during the pandemic was the result of QE and also an enormous fiscal stimulus. According to classical economics, and you should take this with a pinch of salt, consumers will see that they're getting loads of extra money from the government and will do the calculation that the government will increase taxes in the future to pay for the current largesse they're receiving and therefore reduce their spending in future in anticipation of future taxes. It's an economist's argument. I will leave it there. One thing that certainly did occur during the pandemic was households used part of the money they received from the government to pay down debt. Now that actually destroys money, because when you take out a loan, the bank essentially just credits money to your bank account. It creates that out of thin air. And when you pay it back, that money is essentially cancelled. And studies confirm that when households receive a one-off payment from the government, they tend to spend only around 30% of that. And in particular, during the pandemic, businesses borrowed enormous amounts to build up precautionary cash buffers, which they did not ultimately spend. They ultimately gave them money back. Hence, you'll see that M2 actually declined over the last couple of years. But remember, the monetary formula PQ equals MV. And if you increase the money supply, M2, then unless the velocity of money keeps on falling, then inflation, a rise in the price level, is bound to occur. And what you saw during the pandemic was there was a big drop in the velocity of money initially, but then the velocity of money rose back towards its pre-pandemic level. And so that money, that extra money pumped into the economy, did circulate and did raise the price level.
So can I just chip in here, Keith?
Yeah.
I mean, PQ equals MV is a self-referential argument.
Go on.
Well, because it's an equality,
yeah,
by definition, if everything stays the same, you increase the monetary supply,
yeah,
the money supply, then either if velocity stays the same, either P or Q has to change.
Yeah.
But velocity, we don't know what the velocity of money is other than by applying P, Q, and M.
Yes, completely. So you solve for V, basically.
So it's to my mind, it doesn't mean a great deal.
Well, I agree with that.
Because
But
the velocity then becomes, it almost becomes a fudge factor, which makes the equation work.
yes, no, that's true. But in theory, velocity is the rate at which the money circulates through the economy. And so if you the point is that if you keep on adding M, then unless that money just sits in bank accounts doing nothing, then the price level has to rise.
Okay.
But I take your point that nobody can measure V. You just solve the equation and get V out, basically.
Yeah.
No, yeah.
To my mind, it's very unsatisfactory because it's not something that you can measure. It's just it's an abstract concept that works with the equation. Anyway, sorry, I didn't mean to interrupt. But I always, when PQ equals MV is introduced as part of the discussion, I always think it's quite unsatisfactory.
Yeah, no, I agree with that. But I think, as a way of thinking about money, as opposed to measuring, inflation, etc., the price level, then I think it's quite useful. I agree in a practical sense that it's not necessarily. But this chart shows consumer loans in the US, and you see they did fall quite sharply during the pandemic as consumers did use some of the pandemic stimulus to write off existing debt, to pay down existing debt, and that destroys money. So previously we talked about why an increase in the money supply need not lead to inflation, but in the long run, there is a positive relationship between monetary aggregates, i.e. M2, and the general price level, because otherwise the velocity of money would have to keep on falling, and it doesn't. Studies have also shown there's a stronger relationship between household cash balances and inflation than between M2 and inflation. Now, the way the pandemic stimulus checks were done was different in the US and in Europe, and in a way that in the US, it could well have been more inflationary. Now, we previously stated that household balances are more associated with inflation than M2. Now, in the EU, most of the pandemic stimulus was provided as subsidized loans which were repayable to private sector companies. So private sector loans to private sector companies supported them and supported salaries. In the US, most of the pandemic stimulus was actually forgivable loans to companies to pay wages and direct fiscal transfers to households. So you had 1.13 trillion in direct fiscal transfers to US households. As a result, they built up an enormous excess of savings, and we know they've now spent that. As a result of that, US consumption rapidly returned to trend, whereas in the EU and the UK, it didn't. So that looks like the direct fiscal transfers in the US supported consumers and consumption much more than the EU or the UK. Okay, so from all that, did the increase in the money supply cause the inflation? I think we can say no, that was caused by the supply shocks. But I think what you can say is the permanent rise in the price level was facilitated by an increase in the money supply. So imagine if there'd been no increase in the money supply, i.e. under a gold standard. And warning, next week I'll be doing a piece on why the gold standard or new gold standard is an incredibly bad idea. If we'd had a gold standard, you could not have increased the money supply, and therefore the price rises would have been unsustainable. And so the real economy would have had to adjust, and that would have meant a deep recession, a decrease in demand to bring prices back down to their previous level. And in a modern society, that would have been totally unacceptable. As it was, the increase in the money supply allowed prices to adjust without undue strain on the real economy. But my problem is, what is an appropriate level for M2? So when the central banks did enormous amounts of QT, they had no idea what the appropriate level of the increase in the money supply was. And so I agree that an increase in the money supply was necessary, but this was an artificial situation, and the QE done by central banks increased the money supply artificially. And the very fact that QT is proving so difficult shows that it's not a symmetric policy. And who knows what the correct level was? They were guessing. We don't know. And the other conclusion is the pandemic fiscal stimulus in the US was tilted much towards direct fiscal transfers to consumers. And that may have been more directly inflationary than in the EU and the UK. And that may be why the US inflation took off earlier, but also why consumption has proved much stronger in the US. Richard, was that clear?
Well, I would say, Keith, thank you for doing all the research, and it's jolly complicated, isn't it?
Yeah.
I mean, clearly the pandemic inflation was caused by a supply shock, but I agree with you that it was also probably enhanced by the increase in the money supply. And the supply shock is really you get a very rapid response. Prices with a supply shock will change very quickly. I suspect with the money supply, prices change more slowly.
So to pick you up on the language, Richard, wouldn't say it was enhanced. I would say that the change in the price level was made more permanent by the change in the money supply. If you hadn't had the change in the money supply, you would have had prices tending to go back to their previous level, but you would have had to had a recession because people just couldn't have afforded goods.
Yeah, it's a bit like the money supply has adapted to the higher level of prices.
Yeah,
permanent and enable that to fix permanently. So, I mean, it's interesting. And what is the lesson for policymakers is interesting, isn't it? So we've had substantial increases in M2 over many years without inflation.
Yeah.
So the disinflationary effect of globalization and now we have. I mean, we have deglobalization, which we know we have. We've had an inflationary shock with the pandemic. We have currently underinvestment. We have a world whose demand for commodities is increasing, but we've had underinvestment in commodities.
Yep.
And commodity exploration discovery. And so my question then, and I think what you've done is really interesting, Keith. My question then is, having sort of got over, and I think it's probably fair to say that the economies have got over the inflationary shock of the pandemic, both with supply shortages and the increase in the money supply. Are we now going to have another inflationary shock with commodity price increases?
Well, I was thinking about this today, Richard, and I think that, certainly commodity prices are increasing, as in the case of copper, and we cover this every week.
Yeah.
But that is not good inflation. In the form means that prices go up, and we still have high interest rates, and that is actually a drag on consumption in a way that wage growth is, inflationary but good for consumers.
Yeah.
Where commodity price rises, I mean, the most obvious one is oil. High oil prices are actually deeply deflationary.
Yeah.
Because they suck the money out of people's pockets they can't spend on other things. And actually, so a spike in the oil price tends to be a precursor for recession. And so the fact we're getting all these rises in commodity prices at the same time that we have very high interest rates, I don't think that is sustainable, because what that means is you're going to have interest rates going to have to stay higher for longer, and that will constrain economic growth. So
what happens then if the central banks decide that this constraint is not acceptable and they do more QE to offset the drain of increased commodity prices on the economy?
Yeah, well, that's a good question. That is a very good question, because frankly, I think they will do it.
Yeah.
Now, so the net effect of that was you artificially suppress interest rates.
Yeah.
And the currency takes the strain.
Yes.
So you devalue your currency. Now, the question is, against what? If everyone does it, you all devalue yourselves at the same time.
So then the devaluation is against the real asset, isn't it?
Yes.
It is in fact against the commodity or the building or the land.
Yeah. So gold in particular would go through the roof.
And you get and you get generalized asset price inflation, which of course,
yeah.
And we have had localized asset price inflation for the last 10, 15 years.
Yeah.
In the stock market and the property market.
And I think it is incredibly unfair, because it privileges people who own assets against people who don't own assets. Now, actually, I have a chart later on which shows that when you look at the wages of the different generations, so Gen X and Gen Z and millennials, you'll see that actually, contrary to everyone's, well, certainly my prejudices, the millennials are actually doing much better than any previous generation in terms of their wages. And The Economist was saying, this is evidence that actually the millennials are doing just fine. I just don't think that's true, because actually they've seen the price of all the things they need in the to live, such mainly houses, have gone through the roof, and they can't afford the lifestyle that we had. And my dad bought his first home for $3,000.
So they could afford lots of the fripperies, if you like, and I don't mean that in a sort of demeaning way, but going out on a Friday night, but they can't afford to buy a house.
Yep. So, but I also think that the central banks need to get inflation under control, and they need to be getting interest rates down, because a lot of the big infrastructure projects that we have in this country, such as mainly wind and solar, but like nuclear power, they require enormous amounts of capital. And at 5% interest rate, so talking about 7 or 8% per annum, you just can't fund a 15-year build. You need interest rates at 2 or 1. And will they get QE back to suppress interest rates to those levels? I suspect they will.
Well, we're moving on to the subject of yield curve control, Keith.
Yes. Yeah, I think, he says, talking his own book, eventually I think that it has to come back, or they have to get in natural interest rates down. But, when you look at the fundamental problem is that a lot of the big investments we do in this country, such as wind farms, they are incredibly low yield. They're very unproductive compared to, let's say, digging oil out of the ground.
But they've been facilitated. The irony is they've been facilitated by low interest rates.
Yeah. And if we want more of them, we need low interest rates. It's as simple as that.
This is confusing me, Keith, I have to be honest. So
Yeah.
what I would say is that this subject is incredibly complicated. For the investor who is trying to look at the macroeconomics and work out where it is best to put their money, it's extremely difficult because there are so many complex moving parts, and trying to determine which one, I'm trying to understand them and then determine which one might have ascendance at any particular time is very, very hard indeed.
No, well, I agree. And, frankly, you've seen from my portfolio, I've got this totally wrong. I do spend a lot of time looking at the macroeconomics, and
I don't think you've got it wrong, Keith. And I just think you have a and who was to know when you made and I don't have any particular claim to have particularly good timing at all. I was invested in precious metals for years before they did anything. I just think it's a question of timing, and it's one of these things where I don't think you can get the timing right. But I don't think your thesis is wrong. I just think it's displaced in time. And
it's great to have you back, Richard. I need some positivity,
But I also think actually
you should charge. You should it's like
the council, the peanuts.
Those adverts you get everywhere. Every podcast you listen to is like Better Health, I think it's called.
Yes. So I think that what you're doing with bonds and what I'm doing is with precious metal, I think that they are the same. It's the same thesis expressed differently.
Well, let's hope so. I think 2% real yields. No, I'll take that, frankly. Anyway, on that bombshell, I hope that was comprehensible. Bottom line is, increase in the money supply is really needed to avoid, when you get a supply shock and prices rise, the extent that we had in the pandemic, then you would have had a deep recession if we hadn't also increased the money supply.
And without preempting the work you're going to do on the gold standard, it puts the BRICS in a somewhat tricky situation, I suspect, doesn't it? In that they need the gold standard or something similar, partial gold standard, whatever it might be, in order to escape the influence of the US dollar, get out, because they're desperate to get out of it. And it probably is the best way of doing it because it gives stability to their to that currency system. But it has disadvantages as well. Yeah,
no, it has big disadvantages. We'll talk about this in some depth next week, Richard. But basically, you end up with a much more volatile economy. And, actually, if you're the Chinese, you can probably, you can repress the people when they're unhappy. That might work. But in a modern democracy, it don't.
Interesting.
And on to Inflation Watch. So this week we had UK numbers, as we reported, and inflation fell sharply due to the fall in energy prices, though not as much as the market had hoped. Now, turning to the US, this chart shows inflationary pressures are subsiding. So the yellow line are components of the CPI basket with inflation year on year of more than 3%. And you can see that it's still high at almost 40%, but it is falling sharply. The white line is inflation components with actual negative year on year inflation. They are rising. So the general picture is components with low or negative inflation rising, components with high inflation falling. And as a result, those broad deflationary forces, US companies are citing inflation in their earnings calls much less than they were. And we've covered this many times, but broad measures of the US labor market all show it's gradually weakening. As a result, wage growth should slacken in the coming months, and that should ease inflation. Rental inflation in the US year on year was minus 0.8% in April, and that should also help inflation come down. Unfortunately, US car insurance continues to rise. It's up 42% over the last 2 years. And as we've talked about previously, that is due to changes in drivers' behavior. And that is likely to continue in the coming months. And the interest rates will not affect that at all. So, large part of US inflation is car insurance, and as a result, that will tend to keep US interest rates higher than they otherwise would be. Not a problem now when the US economy seems to be doing just fine, but if the US economy starts to slow, that would tend to cause monetary policy to be tighter than it otherwise would be. Elsewhere, the Suez Canal continues to have disruptions, and those disruptions are getting worse. Fewer vessels transiting, and as a result, freight rates are rising, and that should feed through to goods inflation in 6 months' time. Punters are concerned about stagflation after US GDP growth disappointed and inflation proved persistent. This is searches for stagflation. It jumped after the GDP numbers. The good news is the ECB is forecasting that euro area inflation is set to slow to 2% by mid-2025. They meet in 2 weeks' time. Will they cut rates? I think they will, actually. We will see. And contrary to perception, certainly my perception, inflation in the US has not eroded living standards. This is the percentage of current income that different quintiles in the US need to spend to get the 2019 consumption basket. In all cases, it's negative. So people need to spend less of their current income to achieve their 2019 consumption bundle. US households are richer than they were. This is from Goldman Sachs, and it shows the gap between total labor demand, that's job openings plus employment, and labor supply, i.e. the labor force. And you see in UK, US and Euro area, the labor markets have normalized. In Australia, it ain't. So in Australia, there's still much more demand for workers than there are workers available. And that's inflationary in Australia, but elsewhere, labor markets are normalizing. And one of the reasons that the US labor market is normalizing is that they've had massive net immigration. So a record 3.8 million immigrants last year alone. That will fuel both economic growth and inflation in the coming years. But when we're talking about household consumption, the blue line on the left is US household consumption. And since the pandemic, it's up about 12%. So US consumers consuming about 12% more than they did pre-pandemic. In the contrast, the Eurozone, it's about flat, up 1%. The UK, it's down. So UK households are poorer than they were. US ones, much richer. Now, when you think about the fundamentals of inflation, so this chart shows the estimated output gap in the US, dark blue, Eurozone, light blue, and UK. And word of warning, the output gap is very, very difficult to measure. But in the UK and Eurozone, there's a negative output gap, i.e. the economy is operating under capacity and therefore should be able to grow without sparking inflation. In the US, it appears to be operating above capacity, and that is inflationary. So one of the causes of US inflation, according to this, is that demand exceeds supply, and there is a positive output gap. So in summary, inflation continues to fall. Wage inflation is persistent, but that is largely a function of historic inflation. If you look at the current supply demand in labour markets, well, labour markets continue to cool, and that should bring wage inflation down in the coming months. And onto recession watch. So one of the data series I was showing earlier was the Citigroup Economic Surprise Index. And what this chart shows is that the green line is soft survey data, which has collapsed. The red line is hard data, which has hardly changed at all. And the reason that a lot of economic surprise indices are showing big falls in the US economy is because of the decline in the survey data, i.e. how consumers and companies are feeling. Well, it's not necessarily reflected yet in how the actual economy is doing. So be wary about extrapolating the economic surprise indices into actual economic data. It largely reflects how consumers are feeling, not yet how they're behaving. Now, this chart shows changes in gasoline demand in the US starting from the first week in April. And does that show a slowdown in the US economy? Certainly, gasoline demand is substantially lower than it was either in the pandemic average or last year. And US workers are feeling increasingly job insecure. This is a household survey asking whether they felt they were likely to lose their job. And we've talked previously about US corporate bankruptcies and how they're rising. Well, they are rising, but when you put it in long-term context, they're not terribly elevated. I think mild distress is probably an accurate evaluation. Meanwhile, bond markets continue to forecast an imminent recession. So far, they've been wrong. Will they be right eventually? Now, the longer interest rates stay high, the more they will start to affect companies that have locked in cheap debt from the pandemic and then need to refinance them. And that will affect small companies larger, more than big ones in the coming years, particularly from 2026 onwards. During the week, we had earnings from Target, the US retailer, and their shares fell quite sharply after they reported an 8% decline in earnings and a 3% decline in revenue year on year. And both Target and Walmart are intending to cut prices on thousands of lines of merchandise, and they think the US consumer is increasingly price sensitive and showing signs of being tapped out. Elsewhere, Japanese GDP fell 0.5% in Q1, so not doing well despite the weakening yen. In summary, not much sign in the hard data of recession in the US, but Target and Walmart are seeing falling US consumer demand and intending to cut lots of prices to try and entice consumers back. Okay, onto other charts. I thought this was astonishing. So this is the proportion of S&P 500 companies mentioning AI in their quarterly earnings calls. 41%. That's an amazing number. Has risen incredibly quickly. AI adoption appears to be happening very quickly. And that will mean we're going to need a lot of data centers. AI requires a lot of electricity. Good for utilities, utility stocks. Now, I mentioned this earlier. This shows the wages in 2019 prices of the different generations. And as you'd expect, each generation is richer than the previous one in terms of their salary, the real value of their salary. However, as I said earlier, this does not account for the rise in asset prices and the fact it's now very difficult for Gen Z to buy a house. Now, one thing we'll be keeping an eye on is COVID. I've been reading reports of new COVID variants and the possibility of new outbreaks. But so far, the latest data shows no outbreaks. Let's hope that continues. I thought this was amusing. So everyone's very keen on AI, but thank you to a Discord member, Magnus, for pointing this out. So somebody has typed into this search engine with an AI overview, "The cheese is not sticking to my pizza. What should I do about it?" And the advice is, the cheese can slide off pizza for a number of reasons, including too much sauce, too much cheese, or thickened sauce. And the AI's recommendations how to fix this were included adding about 1/8 of a cup of non-toxic glue to the sauce to give it more tackiness. It's logical, but I think the AI recipe book needs a bit of work. And on to good news. So these are white rhinos, and Africa's largest NGO, African Parks, has acquired 2,000 of them from a South African multimillionaire who had bred them in order to sell their horns. Now, CITES, the international organization which regulates the trade in endangered species, refused to allow him to sell the rhino horn. So he sold them all. And they're now hopefully going to be reintroduced into the wild. The first 40 have been sent to the Muniwana Conservancy in Zululand, and the rest will be sent to homes throughout the continent over the next 20 years. Let's hope that that leads to a reintroduction of the species. On to equities. So good week for the global equities, up 1.6%, up 9.2% year to date. All share, though, having had a tremendous run, actually fell 1.1%, down 7.4% year to date. Euro stocks also weak, down 0.6%, up 8.8% year to date. Given the weakness in the Eurozone economy, I find that astonishing. S&P 500 up another 0.5% to new highs, up 11.6% year to date. Nasdaq powering once again to new highs, up 1.5%, up 12.9% year to date. Russell 2000, though, not doing so good. Still above the 2000 level, though, but down 1.2% on the week, up only 2.2% year to date. Hang Seng, having had a tremendous month, fell 3.3%, now up almost 11% year to date. Topics continue to grind higher, up 0.3%, 16.4% year to date. Bitcoin up 3.3% on the week, up 60% year to date. Sterling better on the back of raised interest rate expectations, up 0.5%, down 0.2% year to date. Euro fell 0.3%, down 2% year to date. Dollar index pretty stable, up 3.6% year to date. VIX, amazing, dead as a dodo. Options markets not pricing in any volatility. Does that harbinger a big rise in volatility? Markets seem overly complacent. Some charts related to equities. Well, the euphoriometer is very high. Everyone is super bullish. Generally, that's a bad sign, as shown on this chart. So the dark blue line is the Goldman Sachs bull bear market indicator. There seemed to be an inverse correlation between everyone being bullish and the start of bear markets. Let's see. And the Nasdaq 100, which is in blue, seems to have totally decoupled from the economic surprise index, so i.e. economic fundamentals. So as I discussed earlier, the economic surprise index seems largely to be driven by survey data and sentiment rather than hard economic data. Now, the blue bars are earnings expectations for 2024. The light blue are for 2025. And what they show is the MAG 7, which is on the left, we expect to have 28% earnings growth in 2024, slowing to 17% next year, whereas the remaining 493 stocks are meant to have 7% this year, 13% next year. Now, if the US economy continues to slow, and it does appear to be slowing slowly, then at some stage those earnings expectations are not met, and that's bad for the stock market. But right now we have a very broad-based rally. 77% of stocks in the S&P 500 are above their 200-day moving average. But all the earnings growth is coming from the NASDAQ 100, which is the red line. That's their 12-month forward EPS. If you exclude them, all the other stocks in the S&P 500, their forward earnings has gone absolutely nowhere at all for the last 2 years. If you look at the market cap of the US equity market compared to GDP, it's at an all-time high if you exclude the pandemic when the denominator GDP collapsed, whereas the rest of the world going nowhere. But then that's a function of earnings. US earnings are going through the roof and forecast to continue rising, whereas the rest of the world going nowhere. That is in part a function of profit margins. Now, in the US, the profit margins are high by historic standards and forecast to keep rising. Now, in part, that is a function of, and in part, that is due to the government not imposing competition policy and allowing too much consolidation in sectors. So you have fewer competitors in any segment and they have pricing power, which allows them to drive up their margins. Good for companies, less so for the consumer. The very high PE ratio of the S&P 500 now portends low returns going forwards. Bank of America are forecasting returns over the next 10 years of about 2%, very low by historic standards. The stock market is expensive and everyone is long. So the proportion of people's financial assets they put in the stock market is very high. Now, talked previously how the best predictor of future equity markets returns are allocations to equities. And unless that keeps rising, then equity returns will tend to disappoint. And it's at very high levels. Now, this is interesting. Now, this is interesting. Thank you to Jaw It for sending me this. This is the blood indicator. And it is the 3-month yield over the high yield spread. And it forecasts recession when it's both positive and falls back below its 100-day moving average. Now, the high yield spread, when that starts to widen, that brings the red line down. And the high yield spread would widen when the market becomes concerned about defaults in high yield companies, i.e. highly indebted US companies. So right now it's showing no sign of distress. And so this is not showing any worries about a coming recession. We will continue to monitor it in the coming months. Thank you to Jaw It. On to commodities. Quick summary. Oil was weak due to continued inventory build in the US, natural gas strong. Industrial metals, both copper and nickel hit new highs and then fell back sharply. Tin was strong. Precious metals generally weak. Gold hit a new high and then came back sharply. So energy commodities, this is Brent down 3.1% on the week. And I think you'd say that is an ugly looking trend, falling on concerns about demand. Same for WTI. Some numbers specific to the oil market. Well, big build in US inventories. So the US was oversupplied again last week, hence the fall in the oil price. US crude production was stable at 13.1 million barrels, well down on the start of the year, and we're now 5 months into the year. So the EIA is forecasting US production to start growing again in H2. Let's see what happens. The Baker Hughes rig count rose by 1. Now, EU natural gas prices had a bad week, i.e. they were up 16%, very bad for European industry and European consumers. And that was due to, pause, have a read, disruptions from Norwegian gas flows due to maintenance on the Troll gas field, but primarily due to expectations of a drop in European wind power in the coming week, both of which should be temporary. UK natural gas futures also rose. Let's hope that is temporary. US natural gas futures, they're up very strongly from their lows and up now 11.6% year to date. Another strong week. Coal down a bit, down 1.7% year to date. Uranium up 1.5% on the week, but pretty flat on the year, going nowhere. Industrial metals, aluminium spiked and then didn't. Is that a double top? We ask ourselves. Up 9.8% year to date. Cobalt's going nowhere. Copper spiked, hit a new high, and then retreated from that high. Is that a pause in an ongoing bear market or a near-term peak? We'll see. Now, the Chinese have been stockpiling copper. As a result, they've got too much of it, which means that the premium for delivery of copper to China has collapsed. And actually now you get a better price delivering it to the LME in London. These are Chinese copper stocks. This is very odd. They're stockpiling copper. Now, historically, when the Chinese government attempts to do an industrial stimulus program and tells its banks to loan to industrial companies, one thing they do is they start speculating in copper. Is that what they're doing now? Are they buying copper with cheap subsidized loans? Medium term, though, the outlook for copper is very strong. So this is Indian copper consumption. There are lots of developing nations like India that need electrification, big copper demand, plus the energy transition. Chromium going nowhere. Iron ore seems to have stabilized, down almost 20% year to date. Lithium going nowhere. Neodymium going nowhere. Nickel spiked hard and then fell back. Slightly mystifying, given that we know that Indonesia is going to be producing vast amounts of nickel over the next few years, and it's in structural oversupply, but nobody seems to have told the market. Tin, another good week. Tin doing very well, up 31% year to date. Ferrovanadium going nowhere. Zinc, another good week. Zinc is in a bull market, up 15% year to date. On to precious metals. Gold had a good week and then it didn't. spiking and then falling sharply to end 1.7% down on the week, still up 14% year to date. Silver up 2.4% on the week. So it's fallen back, but still ended up on the week, up 26% year to date. Platinum also spiked, but fell back sharply, ending 4.1% down on the week, up 6.7% year to date. Rhodium going nowhere. Palladium fading again, down 1.7% on the week, down 19% year to date. Finally, onto rates. Bad week in the UK. The yield curve shifting decisively higher, sadly, for me, after what the market took to be disappointing inflation numbers. The bottom line, though, is that UK CPI inflation is now 2.3%. So real rates in the UK are 3%. So monetary policy is actually tightening in the UK. Problem for the Bank of England is wage growth is persistent and services inflation is persistent. So despite headline inflation returning towards the target, interest rates are going to stay higher for longer. US yield curve also shifted up a bit on the week, but down from a month ago. The market is expecting QT to continue for the next 2 years, so 24 and 25, and then the Fed is expected to start buying again. So that's QE returning. Now, at the start of the year, the market was expecting 2 UK interest cuts by June. Now it ain't expecting any at all. It's expecting the first cut in September. And sadly for me, the drawdown in the US 30-year Treasury is just the worst since 1919. US 30-year not doing well, not recovering yet. This is UK 2-year, bad week. So market pushing back on expectations of UK interest rate cuts. 10-year pushing up towards the highs of the year, not good. 30-year, the same. All pretty awful for me, sadly. US 10-year also rising again. German 10-year. I'm surprised at this, given the ECB could start cutting rates next week, but wage inflation in the EU has proved worse than expected. Perhaps that's leading to the rise in the bond yields. This is Italy and Greece. Concluding comments. Well, not much data this week. US services inflation is persistent, and that has led the market to push back on expectations the Bank of England will start cutting rates in June. US PMIs were much stronger than expected, and that shows the US economy that remains resilient and breaks the trend of weaker US economic data. EU wage inflation was much higher than expected. Will the ECB start cutting rates when it meets on the 9th of June? And on to me. How did I do? Well, that inflation number in the UK was really bad for me, down 2.9% on the week. Having a really shit year, frankly. And so far, I've got this totally wrong. I mean, but I still believe that bond yields have to come down. And I've been very wrong about the link between inflation and bond yields, because I've been absolutely right about inflation. Inflation in the UK has come right back down very quickly. It's now at 2.3%, but bond yields really have not moved, which is a great surprise. Now, I think when the Bank of England finally does start cutting rates, the bond yields will respond. Reminder, the term premium in the UK is negative. So bond yields are the sum of interest rate expectations over the coming period. So the 10-year the 10-year yield reflects interest rate expectations over that period. Now, going forward, I don't think the UK economy can thrive at these interest rates. And when you see the level of UK consumption in the charts I showed earlier, is lower than pre-pandemic. So the UK economy is not doing well. At some stage, it needs to cut rates, but in order to do that, it needs to get inflation under control. So I see the path for UK interest rates as higher for longer, and then start cutting and cut further and faster than the market is currently assuming. But right now, not looking very clever. And this is all the problems. This is T68, and started the year, it leapt to the best part of 80 and has now collapsed back down to 64. And really, it's gone nowhere at all since mid-January. But you're now getting a real yield of 1.2% and implied inflation of 3.4%. Bear in mind, that is RPI inflation. So, looking at CPI inflation at 2.5% and a real yield of 2%, that's all tax-free because it's a capital gain. Great, actually. In order to, if you're a higher rate taxpayer and you're getting that in interest, so, you're talking about a real yield of 4.5%. So you would have to make the best part of 8% in interest if you're paid 45% income tax on that in order to get the tax-free return on T68. So as long as I hold this, I don't really have any worries, but it is frustrating, and I've, not looking very clever as equity markets go up, and I'm not participating. But I'm remain puzzled by the fact that inflation is coming right back down, and bond yields are not. And I don't think we're moving into a period of structurally higher inflation. Okay, that is it. I hope you're all doing much better than me. Not difficult. Please, can you press like and subscribe to the channel? And in the meantime, it's goodbye from me, Keith Jordan. Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal, or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.